Welcome to the debate. So today we are standing at a very specific and I'd say very expensive crossroads. I want you to picture a high net worth individual. Maybe they're a tech executive, a founder who just had a partial exit, or a partner in a professional firm. They've had this incredible run-up. Their earnings are at a peak, their energy is high, and they're staring at a portfolio that represents years, maybe decades of momentum. But now they face a decision that feels, well, asymmetrical. One wrong move could erase a decade of grinding, but playing it too safe could quietly cap the explosive potential of their wealth just as the compounding engine is finally warming up.
It really is. It's the classic high earners dilemma, acceleration versus preservation. And to really frame the stakes here, I want to use that tale of two sailors analogy from the Commons Capital Research because it just captures this perfectly. So picture two sailors. They have identical ships, identical maps, and identical supplies. Sailor A launches in, say, 1990. They get fair winds, a roaring bull market. They don't just survive, they look like a genius navigator. They make record time with minimal effort.
And Sailor B?
Well, Sailor B launches in 2000. Immediately, they hit the dot-com crash. Then, just as they stabilize, they hit 9/11. They are battling 30-foot waves just to stay afloat. They burn through their supplies, their capital, just to survive. By the time the weather clears, Sailor A is retired in luxury, and Sailor B is broken, supplies gone, miles behind. The difference wasn't skill. It was the sequence of the weather. The question today is, when you see storm clouds on the horizon, do you drop the sails and hide in the harbor, or do you trust your ship and press on?
And that is exactly where we separate. I am arguing for offense. I believe that when your human capital is high, when you have that momentum, retreating to safety is actually the risky move. It's a mathematical error disguised as prudence. We need to talk about wealth concentration, smart leverage, and aggressive compounding.
And I am taking the side of defense. My argument is that wealth preservation isn't about fear, it's about math. It's about mitigating what you just mentioned, that sequence of returns risk, and prioritizing optionality. Because once you've won the game, the only way to lose is to keep playing at maximum difficulty.
See, you're conflating winning with stopping. There's this dangerous misconception that once you hit a certain number, you should throttle back. But mathematically, switching to defense too early is a disaster for potential wealth. I mean, just look at Warren Buffett, right? The Economic Times points out that $81.5 billion of his net worth came after his 65th birthday. Just think about that for a second. The secret wasn't that he got safer when he got rich. The secret was uninterrupted compounding on a massive base.
Okay, but Buffett he's the ultimate outlier, not a replicable strategy. And crucially, Buffett didn't have a high burn rate relative to his capital. He still lives in the same house in Omaha.
The principle holds for our high earner, though. The accumulated base is finally large enough to generate significant returns. If you have $5 million and you make 10%, that's $500,000. That moves the needle. If you throttle back now, moving to bonds or cash to feel safe, you are effectively cutting the tail off your wealth trajectory. You're stopping the snowball right before it rolls down the steepest part of the hill. And on top of that, high earners often view their careers as a bond. They have this stable, high-income stream. That income is the safety net, which justifies taking higher risks in their equity portfolio. The career is the hedge.
You're treating the career like a guaranteed annuity, which is a massive assumption. But let's just look at the portfolio math first. You're talking about the potential for gain, but you're ignoring the mathematics of loss. Recovery is mathematically harder than loss. And this isn't my opinion. It's arithmetic. As Weekend Investing notes, if you have $100 and you lose 50%, you have $50. To get back to 100, you don't need a 50% gain. You need a 100% gain. You have to double your money just to get back to the starting line. That's the brutal reality of the geometric mean.
But volatility is the price of admission for returns. You can't have the upside without the chop.
Volatility is one thing. Sequence of returns risk is something else entirely. Commons Capital makes this crystal clear. It is not about the average return. It is about the order of the returns. If our high earner keeps their foot on the gas and hits a 30% drawdown right as they transition out of that high-income career or right as they have a liquidity need, they are locking in permanent losses. This is what Alpha AI calls volatility drag. A portfolio that avoids deep drawdowns beats a volatile high-return portfolio over time simply because it spends less time underwater. You simply cannot compound money that you've already vaporized.
Okay, but you're assuming the only way to handle a downturn or a cash need is to sell assets. That's an outdated view. That's how retail investors think. We need to talk about the new logic of leverage.
Leverage? We're talking about preservation, and you want to introduce debt into the equation?
Absolutely. Ennis Global discusses this explicitly. The ultra-high net worth, they don't sell, they borrow. Let's break down the math, because this is where people get stuck. Say you need $1 million for a lifestyle upgrade or a new venture. If you sell $1 million of stock, you trigger a capital gains tax, maybe 20 or 30%, depending on where you live. That money is just gone. It never compounds again.
Sure, you avoid the tax, but you take on interest. You're adding risk.
Exactly. You use securities-based lending, or SBL. You pledge the portfolio and borrow at a spread over the base rate. Let's say your cost of debt is 6%. If your portfolio continues to compound at, 8 or 9% over the long term, you are effectively being paid to keep your liquidity. You avoid the tax hit, you keep the asset working for you, and you solve the cash flow problem. This is capital efficiency. You aren't selling into a storm, you're building a bridge over it.
I'm sorry, that just sounds like a recipe for absolute disaster, wrapped in a fancy term like capital efficiency. You call it precision, I call it a trap. Q Wealth talks about overconfidence bias. Investors consistently overestimate their ability to handle risk. And when you add leverage, you are just amplifying that risk to a dangerous degree.
Not if the loan-to-value ratio is conservative.
Conservative works until it doesn't. Your assets could be high quality, they can still drop 40%. Look at the historical example from Commons Capital, the 1973-1974 bear market. That wasn't just a crash, it was stagflation. The market tanked and inflation skyrocketed. Now imagine your high earner. A recession hits, their industry gets disrupted. That career bond you mentioned earlier, it breaks. They lose their income. Simultaneously, the market crashes, and because they followed your advice to use leverage, they are facing a margin call.
You're stacking black swans to make a point here.
It's not a black swan. It's a standard recession cycle. They have no income to service the debt, and the bank doesn't care about your long-term compounding. They will forcibly liquidate your assets at the absolute bottom to cover the loan. That is not a bridge. That's a cliff. You've just turned a temporary market decline into a permanent, catastrophic destruction of wealth.
You are painting a worst-case scenario to justify suboptimal returns. Of course, leverage requires management, but let's look at the asset selection itself, because you're assuming these assets are just, tracking the market. I would argue for concentration. Portfolio Pilot released data showing that just 4% of U.S. stocks accounted for all net wealth creation since 1926, all of it.
And you think you can pick that 4%?
I think high earners didn't get rich by buying index funds. They got rich by being right about a specific thing: their company, their sector, their expertise. Diversification is dilution. If you want outsized results, which is how this person got rich in the first place, you need exposure to the winners. The Magnificent Seven or specific sectors where they have an edge. When you diversify into bonds or international value stocks just for the sake of a smooth ride, you are guaranteeing mediocrity. And frankly, diversification often fails when you need it most. In a true crash, correlations spike to 1. Everything goes down together. So why dilute your upside if the downside protection is basically an illusion?
Okay, that is a compelling argument for building wealth, but it's a terrible one for keeping it. You're completely ignoring the concept of identity fusion. Expat Wealth at Work highlights this dangerous psychological trap. High achievers often tie their self-worth directly to their net worth. It's not just numbers on a screen, it's their scorecard.
That's psychological, not financial. The market doesn't care about your feelings.
Sure, but the investor does. And the investor is the one who has to push the button. If you are concentrated in your own sector or your own company stock, and that sector takes a hit, it isn't just a financial loss, it's an identity crisis. We see this lead to depression, isolation, and crucially, panic selling. They aren't selling because the math changed. They're selling to stop the psychological pain of watching their own identity crumble.
So your strategy is to manage their emotions by lowering their returns?
My strategy is to build crisis resilience, as Landsberg Bennett argues. Concentration builds wealth, yes, I'll grant you that, but diversification keeps it. I advocate for the bucket strategy from Commons Capital. You segment your money. You have a liquidity bucket for cash, a lifestyle bucket for safe bonds, and a legacy bucket for stocks. When the market crashes, you don't panic because you know your next 5 years of living expenses are sitting right there in cash and bonds. You don't have to sell your legacy assets. That psychological safety is what allows you to stay invested. If you're concentrated and leveraged, you will panic. And you will sell at the bottom.
They're a slave to their emotions. But let's touch on that psychological aspect, because you're framing safety as the ultimate good. I see a different, more insidious risk: inflation and longevity. Commons Capital points out that safe assets like cash have inflation risk. If this high earner retires at 55 and lives to 95, playing it safe guarantees purchasing power erosion.
Erosion is slow, ruin is fast.
But erosion is guaranteed. The drive for more isn't just greed. It's a necessary hedge against a 40-year retirement in an inflationary environment. If your spending power gets cut in half every 20 years, you need aggressive growth just to stand still.
But at what cost? We have to look at the psychology of money. The Economic Times summary of Morgan Housel's work notes that the hardest financial skill is getting the goalpost to stop moving. This is all about lifestyle creep, as Advisor Finder calls it. As income rises, spending rises to match it. Status signaling, luxury goods. This creates a much higher burn rate.
Which is why they need higher returns, to fund the life they've earned.
No, it's why they are more vulnerable. Listen to the logic here. A higher burn rate raises the ruin threshold. If you need $500,000 a year to maintain your lifestyle, you are far more fragile than someone who needs $100,000, regardless of your net worth. You have less room for error. And the Decision Lab discusses loss aversion. The pain of losing is psychologically twice as powerful as the joy of gaining. If you push for more, inflate your lifestyle, and then hit a drawdown, the psychological damage causes behavioral ruin. You panic, you liquidate, and you lock in the loss permanently.
Okay, I think we need to pivot here because we're dancing around a core issue. It's not just about growth versus safety, it's about decision quality versus volatility.
I agree. Let's reset the tension on that.
I'm willing to admit that volatility is the price of entry for returns, but you are ignoring a massive psychological cost on my side of the ledger: omission bias, the regret of missing out. Imagine our high earner switches to defense bonds and cash too early. They sit out a decade of tech growth. They watch their peers who stayed invested double and triple their net worth.
Social comparison is the thief of joy.
It's reality. If they miss that growth, they permanently impair their lifestyle capability relative to their peers. They might not go broke, but they lose their standing. That regret can lead to reckless behavior later, jumping back in at the top because they can't stand the FOMO. Staying aggressively invested prevents that psychological error. You keep them in the game so they don't do something stupid out of envy.
That is a fascinating way to justify risk-taking. Risk to avoid the regret of not taking risk. But I would reframe defense. Defense isn't hiding cash under a mattress. It is buying sleep and optionality. The Bank of Colorado discusses the preservation phase as reducing the variance of outcomes. If you have enough to win, if you have hit your number, why in the world would you keep playing the game at maximum difficulty?
Because enough is a moving target. And in a world of sticky inflation, enough today is poverty tomorrow.
Only if you let it be. Alpha AI has this incredible insight. Avoiding the deepest 10% of drawdowns matters more for long-term geometric growth than capturing the top 10% of upside. If you cut out the catastrophic tails, the average takes care of itself. I am arguing for a strategy that ensures you survive the storm so you can finish the voyage. You are arguing for a strategy that bets on fair winds just to get there faster.
I am arguing that the ship is stronger than you think,
and the destination is further away than you realize. You are trying to dock the ship when we are only halfway across the ocean.
Let's bring this to a close, because I think we've exposed the fundamental difference in our philosophies. Recovery is not just math. It involves psychology, reputation, and time. I would suggest using guardrails as Commons Capital describes. You use dynamic withdrawal rates rather than some rigid offense or defense switch. If the market drops, you cut spending. But fundamentally, defense is about ensuring you never, ever have to sell a distressed asset to buy groceries. If you can secure that, you can take risk with the rest. But securing that is the first priority.
And I'll summarize by saying that in an era of sticky inflation and technological disruption, the biggest risk is standing still. You must maintain exposure. You should use capital efficiency, borrowing against assets rather than selling them, to bridge liquidity gaps. Don't let the fear of a storm keep the ship in the harbor when the destination is still decades away. That accumulated base is a weapon. You have to use it.
And that leaves us with the unresolved question, the line of fragility. At what specific number does playing offense stop being ambitious and start being a gamble with one's identity and future?
And who gets to decide when enough is reached? Is it the spreadsheet or is it the ego?
That is a question every high earner has to answer for themselves. Thank you for listening to the debate. If you enjoyed this deep dive into the mechanics of wealth, please like this video and subscribe for more finance debates.
See you next time.